Yeah, I mean, there's really quite a long laundry list of key themes for this year for the major currencies. But if we start with the big one, it's the fact that Bernanke is likely to step down, and he'll make that announcement sometime this summer. And what is the continuity there? And does the Fed begin to taper its asset purchases? I think this is going to trigger quite a quite a disruption in the asset markets. I think it will help the U.S. dollar. The Fed needs to stop QE. The ironic thing being, it's not just because the economy in the U.S. might be coming back a little bit. It's also because of the risks to imbalances in asset markets that's going to trigger this need. So I think we'll see the dollar stronger on this, and big questions on who will replace Bernanke. I'm not so sure it'll be Yellen if we're getting a disruptive scenario in asset markets, which I think is a non-trivial possibility. Looking elsewhere, the yen is an obvious candidate. I don't think Abenomics works as intended. QE, no matter how massive, does not provide demand into the economy. So either we just get nothing much going on and the yen back stronger a bit, or people begin to believe the rhetoric over there, and we see inflation expectations rise, and then a sudden tick up in lending, which will require those that are lending to require higher interest rates, and then we see actually a very sudden and dangerous inflationary scenario, which would be aggravated if bond yields around the world are also headed higher. So a very two-way sort of proposition there. I think near term the risk of some yen appreciation, because I think we overplayed the potential for QE, but still some key questions along those other lines for the Japanese yen. Elsewhere, just to make it very brief, the Swiss franc, are they going to move that floor? I think they are going to do something very soon on either discouraging flows via negative rates or doing something about raising the Euro-Swiss floor. And the commodity supercycle and its ending, and what this is going to continue to mean to the downside for especially the likes of the Australian and New Zealand dollars, but also possibly the Canadian dollar. Obviously, with the kind of outlook that I've just outlined, I think volatility is going to be an ongoing massive risk, a two-way volatility. So I think the trader needs to sit back, find a broker that offers options, and look at scenarios, and then take a known risk for a potentially large payout. Because with large volatility, especially with any leverage involved in the situation, the risk is you can be right but not have your timing right, and you're stopped out before the big move happens. I think this is a big risk. Therefore, I would encourage, for some significant part of sort of the longer term trades and potentials for larger movements, to look at the options market as a way to be long volatility as a way to play that.